And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. The Magnificent 7 ETF was one of the biggest ETF hits of the last couple of years, but many investors want to diversify out beyond just 7 stocks. ETF giant BlackRock is looking to address that. Let's talk with Rachel Aguirre. She's head of U.S. iShares products at BlackRock, which has just launched the iShares Top 20 U.S. Stocks ETF. The symbol is TOPT. That consists of the top 20 stocks in the S&P 500. Also joining us, Alex Shepard from ETF Action. Rachel, the Magnificent 7 ETF, I see it's up 46% this year. What's the argument for diversifying into a broader group of the top 20 stocks rather than just, say, the top 7 stocks?
Well, so glad to be here with you today, Bob. And if we start by, let's just talk about the state of the U.S. equity markets for a moment. If you take a step back, there has been just a massive transformation that has taken place in the U.S. equity markets more broadly over the past several years. And, there's a lot of different names to it. The rise of big techs, the FANG stocks, if you go back several years, the Magnificent 7 of today. But whatever label you put on it, what we know is that mega cap companies are having an ever increasing impact on investors in the U.S. stock market today. Now, you mentioned products that have been brought to market, notably the Magnificent 7. Well, what the iShares Build ETFs are designed to do is to deliver a toolkit of simple solutions for investors to be able to capture the growth of some of the largest companies within the U.S. equity market today, but to do so in a broader and more diversified manner. So
you are doing something similar with the NASDAQ here. You also have an ETF, this was launched last week, for the top 30 non-financial companies, and then you had launched the third one as well, I guess you call it the second tier, the next 70, that gives exposure to the 31st largest to the 100th largest companies. So when I look at this top 30 NASDAQ, it looks an awful lot like the S&P top 20 you launched in terms of top holdings. It's got the usual big names in it. This is still really a concentrated bet on technology, whether you're buying a Mag 7 or even the new one that you just are offering here, right?
You're right. And, let me just provide a stat that hopefully will help paint a picture for your viewers today. If you go back to the year 2000, the entire U.S. equity market was valued at $15 trillion. Fast forward to today, the 8 largest companies alone now are worth $15 trillion. So that just speaks to the massive impact that mega caps are having on U.S. equity markets today. Now, notably, when you look at not just their sheer size, but actually how these companies are driving outsized returns for investors, the NASDAQ 100 is a really great example to highlight here. The top 30 companies of the NASDAQ 100 have contributed more than 89% of the total index return over the past 5 years. And so that's really the nexus of what we're looking to do here, which is deliver an easy and accessible way for investors to tap into that growth and innovation of mega caps, whether that be in the tech-heavy NASDAQ space or more broadly within the S&P.
Yeah. What's interesting to me is if you get outside the top 20 or so that you see, the next 70, and I'm talking about the NASDAQ here, is a lot more diversified than just technology stocks. So let's put up the list here. The next 70, I see much lower concentration and fewer tech stocks. So you look here, this is the Q top, but if you look at the next 70, the NASDAQ, I see Micron in it. I see Gilead Sciences there. That's a biotech. I see Starbucks. That's a consumer stocks. Mercado Libre is a Latin American company, and there's Lam Research. So the point here is that this is not just technology. When you get outside of the top 20 here, I guess what I'm wondering is these are all done well. Are there signs that we're suddenly in a period of just extended large cap performance? It's not just necessarily big caps. I'm trying to figure out what's going on here.
Right. And you raise a really important point. It's important for clients and investors to remember that there are split views on this topic. There are many investors who believe that the big will get bigger, that the winners will continue to win, and there's plenty of numbers that point to that and underpin that. If you look at the S&P 500 over this past year, the top 20 companies have had revenue growth of 15%, whereas the remaining companies within the S&P 500 have seen revenue growth of around 4%. But there's also another side to this argument. There are many investors who believe that it's actually a very worrisome time to continue investing in mega cap companies because of just their high valuations, and they would rather lean into those next companies, value heavy companies, which, by the way, are staging quite a comeback in terms of earnings growth. Now, that's why we're delivering an entire toolkit to investors. So whatever your view is on the markets, you have a simple solution to express that view, whether that be in mega caps and top 20, top 30, or whether that be wanting to capture the growth of who may be positioned as the next wave of innovators.
Yeah, Alex, this diversification idea is really having a bit of a moment. We had Defiance ETFs on last week. They were launching the S&P 500 X Mag 7, essentially the other 493 stocks without Magnificent 7, and now we have this one. So, Alex, I get diversification; it's having a moment, but where does this fit in a portfolio? So, if for example, an S&P 500 is my core holding, as it is for a lot of these viewers watching right now, how would diversifying into a top 20 S&P holdings ETF help me?
Right. And I think a big part of it that Rachel hit on is the fact that you're allowing investors to implement their view on the marketplace, whether that you believe the big are going to continue getting bigger, or if you feel the opposite of that. There is the tools that allow you to implement that. Now, if I wanted to possibly take a position in the larger cap companies and I don't want to necessarily sell a position for tax reasons, for example, at least this allows me to do that using if I want to get more concentrated or if I want to get less concentrated out of those names. I will note that while the naming convention of these strategies are very direct for investors to understand, some of these strategies have been out there in the marketplace just with a different name. For example, there are equal weight strategies on the S&P 500 that investors have had access to, and that's a great way for getting out of your concentration in those top names. Similarly, I mean, there's been other FANG plus products, is that what we classify them at ETF Action. So I think the most important thing is we're giving investors more options to make a decision and implement their view on what they think is going to happen in the market.
Yeah. I want to go back to Alex, I want to go back to Rachel's earlier point. She shared some amazing stats on market concentration. And she mentioned that in 2000, I think the entire U.S. stock market was $15 trillion. And today, just the top 8 companies have a market value of close to $15 trillion. I guess what I'm trying to figure out here is higher values for these top companies really a risk if the earnings are indeed growing? Everybody talks about diversification. I personally believe that. But the earnings are going up with these companies at the same time. So I'm wondering, is concentration risk, how serious is the concentration risk here?
No, a great point. And honestly, if you go back 10 years ago, the top 10 weight in the S&P 500 was half or nearly half of what it is today. So today, I think the top 10 names are about 35%. From an earnings perspective, this week is going to be a great test to see, are these valuation multiples being held up by strong earnings? I think if you were to take the Mag 7 stocks, for example, right now, in a portfolio, that has a trailing price to earnings multiple of about 40, whereas the S&P is trailing about 28 right now. So certainly extended valuations. This week, again, will be a great test to see how the market responds to, you've got Amazon, Apple, Alphabet, a lot of these larger tech names to see if the earnings will support the valuation. If they don't come in or blow it out of the water, we could see the potential for a pullback from some of these larger cap tech names.
Yeah, I mean, that's a very good point. I look at I mean, what matters for stocks, as you know, Alex, is forward multiples, not trailing. And even when you look at NVIDIA, it's in the low 30s. Apple's in, high 20s. It's varied, but high 20s, low 30s. Given the earnings growth, that's not a crazy number at all, certainly not compared to what some other stocks are trading with. Rachel, the top 20 largest companies, the stat I have here has contributed more than 68% of the index returns over the past 3 years. So what's interesting is not that they're large in terms of market cap, but they're having an oversized impact on the earnings. I mean, isn't that the point here? Their prices are outpacing the S&P 500 because their earnings are a lot stronger, right?
That's absolutely the point. And, here's another really interesting thing. You talk about clients and the ability to diversify. Investors today may be taking a position on mega cap companies, whether they know it or not. A couple of interesting stats for you. If you look at end investors, we know that nearly 47% of end investors don't own stocks at all. Now, that's a huge miss. We also know that many end investors, when they do have stock allocations, they're oftentimes in very highly concentrated single name positions. But what we also know, which is really interesting, is that many advisors today within their portfolio allocations are underweight mega cap holdings. So the average US blend active fund today is approximately 8% underweight mega cap. When you look at the average asset manager model, moderate model, that's underweight about 7%. So a lot of investors may actually be underweight this segment without potentially even knowing it. So again, going back to what these ETFs are about, it's about delivering tools to investors, simple solutions for investors to be able to more intentionally allocate across the full spectrum of the U.S. large cap equity universe.
Yeah, you bring up a very sensitive subject to those of us here at CNBC. That is about half of the households don't own any stock at all. But the statistics are really a lot worse than that. And Alex, you've talked about this before, and so has Mike Akins. 85% of the value of the U.S. stock market is held by the top 10% of households by net worth. More than almost 95% of the value of the U.S. stock market is held by the top 20%. So essentially, the U.S. stock market is controlled by the top 20% of households, although 50% of the households hold some kind of stock at all. That's a very alarming statistic, and we've been worried about that here at CNBC for years and trying to increase that. It has gone up recently. It went down during the financial crisis, and it's been slowly going up. But the fact is that people who hold financial assets have done much better than people who don't hold financial assets. And this is a great source of wealth inequality in the United States. And I wish I had some solutions to it. Financial literacy and owning stocks and bonds at an earlier age and educating people about the value of that vis-a-vis owning other assets is really the key here. I'm gone on a little bit of a soapbox rant, but I think you both probably agree with me on that. Alex, there's an argument for reversion to the mean, is there not here? I mean, none of the top Nifty 50 companies of the 1960s are still at the top. I guess IBM is still around, but it's not the behemoth it was at one point. Exxon is still around, but again, not the behemoth that it was. If I put on my Jack Bogle hat, Bogle being the founder of Vanguard, I was a student of his, he would say, Bob, this is why you want to hold the S&P 500, because you don't know how long this outperformance is going to last. Is that a fair argument? I'm trying to figure out a reason. Reversion to the mean is a very powerful impulse in the markets.
Right. No, absolutely. I mean, academic research going back decades shows that value has been the outperforming factor when looking at multi-factor models. And the idea is the companies that led the S&P 500 15 years ago aren't the same companies that there are today. So holding the broader based index that has a disciplined process, that has a rebalancing rule, that certainly would be taking a little bit more of a protective stance, but having exposure to the market, going back to the conversation we were having just a couple of minutes ago, is the most important decision, first and foremost, for any investor out there.
Yeah. Do you see, Rachel, more attempts? I'm sure that you believe strongly that this is a good idea at this time, and I think it is as well. It makes sense to me. It's easy to explain to people. How have the flows been? I know it's very early. It's only a week or so, but Magnificent Seven was a perfect product at the same a year and a half ago. This seems like the right product for right now. How are overall flows looking?
Yeah, we agree. We believe it's the right product at the right time for today's market environment. We're really pleased that we've seen some early investment into these products. It's very early days, but nonetheless, we've seen a lot of interest, good volume in each of the products, and we've had some early investor purchases into QTOP in particular, which we're really excited about.
Okay, terrific. Again, this is the hot topic right now. Just like concentrated bets were the hot topic a year and a half, 2 years ago, now diversification is a hot topic. And you see how the ETF industry is responding to that interest in diversification. That does it for this week's ETF Edge. My thanks to Rachel and Alex. We've asked Alex to stick around and provide more perspective on this potentially record year for ETF flows in our ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.